We're going to go much more in-depth about Europe. We're going to talk about rates, unemployment throughout the EU. We're going to bring together two experts who will help us sort this out. Mr. Jacob Kirkegaard is an economist and senior fellow at the Peterson Institute for International Economics. And Peter Schiff is the CEO of Euro-Pacific Capital. Peter, welcome back to the show. Good to see you joining us from Weston, Connecticut. Let me start with you. The ECB, the Europe situation, the last time we talked to when we talked or are talking right now, not a lot has changed, or has it?
Well, I don't think so. I mean, I think you still have central banks that are too loose around the world. They're printing too much money. They're enabling governments to run much larger deficits than would otherwise be the case. But I don't think Europe is making as many mistakes as we are here in America. I don't think there's austerity going on. People are trying to say that there's austerity in Europe. I don't really see it. But I see less stimulus than we have in the United States, and that's going to work to Europe's advantage.
Jacob, he talks a lot about the austerity issue, and this is a hot topic because when we first started austerity in Europe, everyone said that's what they need. The IMF said it, the World Bank said it, and then not more than maybe a year and a half later, it's turned around to where, wait a minute, we don't want to do so much austerity. We want to have the growth. So which one does Europe want?
Well, I mean, there's no doubt if you ask the European on the street, they don't want austerity. But the reality is if you go back 2 or 3 years, the countries in question in the periphery, those in crisis, they didn't have a choice. I mean, they didn't, if they wanted to do stimulus, who's going to lend them the money?
The ECB, speaking of the ECB, left rates basically unchanged. Some were thinking about a rate cut. My question is, does it matter what the rate is in Europe? Would that make the banks lend?
No. I mean, whether it is 50 basis points, 25 basis points, doesn't really make any difference. I mean, it's a matter, the credit crunch in the periphery is related to banks' willingness to lend and the access of these banks to the interbank lending market. And the ECB policy rate is largely irrelevant.
Peter, I'm going to throw you a softball here. If you were in charge of Europe, how would you get things moving along? How would you get the growth? How would you get the jobs? What would you do?
Well, in order to get real economic growth, not just an artificial stimulus-related high, you need to dramatically reduce the size of government. It's government weight that interferes with economic growth. That's why the only real economic stimulus is legitimate austerity, where you shrink the size of government. I would cut government spending across the board. I would try to repeal as many onerous rules and regulations as I could, particularly those that impact employment, that make it extremely expensive to hire people. Why would you want to punish businesses for hiring? So we got to get rid of all those rules and regulations and try to reform the tax code to try to make government as small a burden possible so that the economy can grow.
I'm going to play devil's advocate for you, with you for 1 second, Peter, and that's, look, as awful as some of the policies might be as we look at it, and as terrible as things are in Europe, hey, look at the GDP numbers. I mean, they're only down very slightly. We're talking 0.2%, 0.6%. I mean, it's not a disaster. I mean, is that something to at least think about?
Well, I think they could get a lot more economic growth if they had a smaller government. But in the United States, I think we're actually doing worse than Europe because I don't believe our numbers for a second. I think our inflation rate is much higher than what the government admits. So I think the U.S. economy is still in a contraction. It's just that we pretend that it's growing, and we think that it's growing because of all the stimulus. It's the stimulus that's preventing legitimate economic growth from taking place.
Jacob, this growth issue with jobs, I've heard people say this before. We want the jobs, then there will be growth. Now I've heard we need the growth so there can be jobs. Which one is it?
Well, I mean, there is an obvious chicken and egg here, but there's no doubt that in the countries in Europe, and for that matter in the United States, what you do need to see is a sustained increase in job creation. I mean, jobs comes, in my opinion, in this case, not always, but in this case, comes before growth. Now that, in some ways, is much easier in the United States because, as Peter said, in Europe, you have a lot of onerous and very expensive regulation that basically, as long as it's very expensive to fire someone, you're not going to hire a new worker in the first place. And that's really Europe's core problem.
Let me play futurist here for a second. 6 months from now, a year from now, you're back on the show. What are we talking about with Europe?
Well, I think in 6 months from now, Europe will have, the Eurozone will have exited recession, but it'll be probably, sort of somewhere between 0 and 0.5% real growth. You will have had, unemployment will have peaked, but it will have sort of stagnated, if you like, at around 12%, which is obviously an extremely high level. So Europe will have bottomed out, but it'll be lying down for quite a while.
Peter, I mean, this is frustrating. You talk to institutional investors every day, I'm sure, and what they want to see is growth and profits and jobs creation, and you're just not seeing that out of Europe right now. Is there any other thing, any other way that people can do?
You're not seeing it in the U.S. either. You're seeing rising asset prices, but a lot of that is just temporary. I would agree that a year from now, I think Europe may be less worse off than it is today, and I think it's going to look better by comparison than the U.S. I think that's one of the reasons you saw the euro rise to, I think, a 3 or 4 month high against the dollar. And in fact, if we get a weaker than expected non-farm payrolls number tomorrow, we could see a big spike in the euro. And for all this talk about how things are better in the United States than in Europe, if that were the case, the dollar would be gaining ground against the euro, not losing it. And so I think some people are starting to realize that this growth story in the U.S. is just a story. There's no legitimate growth, just asset bubbles. And I think the effect of that stimulus is wearing off, and more traders are waking up to the grim reality.
Peter Schiff, thank you very much. You have the last word from Euro Pacific Group. And Jacob Kirkegaard from the Peterson Institute for International Economics, thank you very much. Both of you, gentlemen, thank you.